Leading indicators are still going down, which is a sign of weakness. It's been about 2 years since they stopped rising. I learned early on in my career that leading signs were very likely to be wrong if they went down for 3 months in a row. The fact that the leading indicators keep going down means that there is something wrong with the business as a whole. The ESM prices paid also showed that prices fell in the manufacturing sector. That's a sign that things aren't going well in the manufacturing sector. The parts of the business that go up and down are actually going down. Cathie, founder and CEO of ARK Invest, is very worried about the US economy. This comes at a time when people are still arguing about the Federal Reserve's monetary policy and what it means for the economy and the financial markets in the future. A lot of well-known experts, like economist and former Treasury Secretary Larry Summers, have said things about the Fed's choice to lower its policy rate by 50 basis points instead of the 25 basis points that were expected. Summers says that the better-than-expected September jobs number was caused by the Fed's announcement. The problem could quickly get out of hand if the right steps aren't taken. Summers and others think the economy is too hot. But Wood is sure that the US economy is cooling quickly. More rate cuts may be needed right away to stop a bad economic downturn that will send the whole economy into a recession. In the most recent episode of her monthly podcast, In the Know, the CEO of ARK Invest talks about her thoughts on the market. Here are some clips from the video. Please like this video, subscribe to the channel, and turn on post alerts to get more videos like this. For the channel's growth, everything you do is very helpful for the YouTube system. Thanks and have fun with the movie. This shows the percent change from one year to the next between the Fed funds rate and the total CPI. See this chart, it's something that has helped me since the beginning of my work. In the beginning, in the late 1970s and early 1980s, the green line, which shows the Fed funds rate, rose above the purple line, which shows the CPI inflation rate. It stayed above until the tech and telecom bust. Since then has been at or below the rate of inflation until not long ago. Now it's above, and if we're right that inflation rate will keep going down, which means it will go below the green line, which is the Fed funds rate, if everything else stays the same. This means that Fed policy, or real rates as measured by real rates, is very tight. And I heard after today's job report, we'll talk about that soon. Oh no, they cut by 50 basis points, say a lot of analysts, strategists, and people who make predictions. That was way too much. This picture would say without a doubt not. It's not too much. We think the inflation rate will continue to fall until it is zero or below zero. If this happens, monetary policy will become tighter, and we think the economy will be under a lot of pressure. That's why we think the Fed funds rate will keep going down. I saw Governor Goolsbee in Chicago, and he said again that things are going downhill. The interesting thing about that is, what is the reason if the Fed tells us rates are going down and will keep going down? People want to wait and see how low rates stay. The same goes for costs. When cuts and prices go down, people are more likely to say, okay, let me see how low is low. In the coming months, we may still see growth that is surprisingly low. You can see the Conference Board Consumer Sentiment Index. The green line shows the Conference Board's Consumer Confidence Index, and the purple line shows the University of Mishima City of Mishima Sentiment Index. The green line, the Michigan survey, shows inflation more than anything else, while the Conference Board's line shows jobs more. And you can see that lower inflation has made people happier in the University of Michigan poll. But if you look at this level in the bigger picture of history, it is still very low. It's not very hopeful. On the other hand, the Conference Board had been seeing a lot better in terms of history because jobs had held up so well, at least in the headline sense. But now we're seeing some later, and in fact many signs of labor coming down. The Conference Board is also starting to fall apart. I don't think the most recent month is on this list, and it went down a fair bit. It may have reached 98. In the video, Cathie also talked about the September jobs number that was just released. The US Labor Department's most recent report says that the economy added 254,000 jobs last month, and the jobless rate fell to 4.1%. Experts think the report is a huge boost for a job market that has been showing signs of weakness. This is especially true since it was better than traders' expectations, who thought the report would show 140,000 new jobs and the unemployment rate staying at 4.2%. Some people like Summers are unhappy with how strong the job market is. However, Cathie says that the report still sends a lot of mixed signals, with some parts of the economy still showing signs of weakness. Cathie is most worried about the manufacturing sector, which she calls a leading indicator. She thinks that this sector should be showing more signs of getting stronger if we want to avoid a slump in 2025. Here are some more film clips. We had, I think, 254 non-farm payrolls. They had gained 254,000. The goal was to reach about 150,000, and 72,000 more were added to the last 2 months. It's good to make changes that go up. Well, changes going down had been going on for a long time. This is a change, and we need to pay attention to it. As for the strong signs, I will say that they were mostly in healthcare, education, and government. If you looked at cyclical signs, they were still very weak. Very, very weak. There you have it, non-farm wages. In fact, the jobless rate went down from 4.2% to 4.1%, which is what the news story said. A lot of people thought it would go up. It didn't. The average hourly wage was also a bit higher, 0.4% from 1 month to the next. It was expected to be 0.3%. In other words, hourly wages are rising by an average of 4% per year. It looks like productivity is between 2.5% and 3%. That means that if the average hourly wage is 4% and output is 2.5% to 3%, then the real inflation rate is probably between 1% and 2%. That's good. When work gets done, better pay should go up. Some of the wealth is being shared by businesses. The unemployment rate was going down, which meant that industry and temporary help were also going down. Temporary help is a leading sign, but it hasn't been very good at its job for a long time because it has been going down. The number of hours worked went down by about 3%, which makes some of the very good numbers less impressive. And if you looked at this week's ESM service report, employment was surprisingly low, just like it was in the factory part of that report. So once more, there are mixed signals. Based on the first claims made each week, they have been lower than expected, which was a surprise. It was a big surprise that the number of job openings this week was higher than expected after going down a lot last week. That was pretty cool. The only other thing I can think of on the labor side was the Challenger layoff poll. That went up 53% from 1 year to the next. We know there are cuts because we read about them in the news. Year over year, they are up 53%. To give you an idea of what's been going on in the world of economic data over the last month, I'm going to separate 4 things: family, net worth, and change in net worth. That was going up really well. The market has gone up. The cost of homes has gone up. Those are the 2 most important signs. If you look at both of those in the stock market, you'll see that the market is focused on just a few names. That's not a good sign. We'd rather have it get bigger. And in the property market, even though prices are going up, the number of units sold and started has dropped and hasn't come back. Another story is that JP Morgan analysts are excited about October for the cryptocurrency market, according to a study that came out on Monday. In the study, the analysts talked about October's historical trend. They said that Bitcoin has made money more than 70% of the time in October.